Hello, hope all of you are doing well. So, today we are going to discuss the topic national income and its related aggregates, class 12 economics. Undoubtedly, it's one of the most important topics for your syllabus. Every year there are lots of numericals, terminologies, short answers, long answer questions which are asked from it. But before going into how to solve those numericals, how to calculate the national income of a country, what are the related terms and all, we must first introspect into one important thing, which is here is a food for thought. So it's not natural that countries which are endowed with a bounty of natural wealth, be it differing minerals or forests or the fertile lands, are the most richest countries. The economic wealth or the well-being of a country doesn't necessarily depend on the mere possession of these resources. So you can see that the African continent is full of natural wealth and resources. Yet it's highly ironical that some of the most poorest countries in the world are in Africa. The point is how these resources are used in generating a flow of production, and how, as a consequence, income and wealth are generated from that process. Interesting, no? That we have all these resources and all, yet we are not the richest. Why? Because it's not only having the proper resources with you, it's about how you change it into and generate production from it, and as a consequence of it, income and wealth are generated from that process. But before going into all these terms, what is income, wealth, how is the flow of production is happening and all, we need a measure of how much we have produced. And that is what national income accounting does for any nation. So what is national income accounting? National income accounting is referred to the set of methods and principles that are used by the government for measuring production and income, or in other words, economic activity of a country in a given time period. It's more like an accounting exercise, like we do for our own household, right? There are some certain set of methods which we will talk later on, used by a government of any particular country for measuring production and income of that particular nation. For instance, for India, the CSO, or the Central Statistical Office, is responsible for compilation of national accounts. CSO is also responsible for the annual survey of industries, coming out with consumer price indices and all, but those are terminologies which we will keep for later period. Similarly, national income, what is it? It is defined as the net value of all economic goods and services produced within the domestic territory of a country in an accounting year, plus the net factor income from abroad. Technical, huh? Don't worry, we will discuss all these terms. In simple terms, if I have to tell what is national income, it is the money value of what is produced within the domestic territory of a nation, plus a certain amount which our own residents produce in abroad, which is termed as this net factor income from abroad. We will do all of this in detail later on. So this is the technical definition of national income, right? So moving forward, we shall look into some of the basic concepts before moving into what are the methods of national income accounting, what are the various ways we can calculate national income, what is this net factor income from abroad, goods, services, net, gross, etc. First and foremost is consumption good. So what is consumption good? These are goods which are directly used for the satisfaction of human wants. Say, for example, a bowl of noodles or your morning cup of tea. These are all consumption goods, which can be further bifurcated into consumer durables and non-durables. Now, this durables and non-durables has a pretty interesting implication in many different fields of economics and also in national income accounting, which we'll see in detail. So what are consumer durables? As the name suggests, durable means that those goods which have a lifetime period of a longer duration. Say, for example, this fridge, as I've shown here, right? Now, this fridge has a lifetime duration of more than a day, a month, or it can stay for a year. There will be definitely wear and tear, but I'm not concerned about it. I mean, we can use this fridge as a consumption good for a longer period of time, as compared to this bowl of noodles, which if you just keep it for one day, the next day, excuse you can't eat it, right? So that's the basic difference between consumer durables and non-durables. The next type of goods are called capital goods. So these are those goods which are used as fixed assets in the production by the producers in their production process. Which means, like, these are those goods which actually help you to produce other goods. For example, a tractor used by a farmer, a machinery used in a plant, or for that matter, a computer used by an IT personnel. These are all capital goods. We will talk about all these goods, what are its uses later on. But just here, I'm just giving you the basic concepts, right? Because one should be clear about what is consumption goods, what are capital goods, and all. Right. Next up is final goods, which in simple terms means those goods which have crossed the boundary line of production. Now, what is this boundary line? It's not something like a cricket match which is happening, right? That we crossed a boundary. It means like those goods which are ready to use either as consumption good or capital goods. Those are known as final goods. You go to your local kirana store and you ask for a Cadbury. That Cadbury, that chocolate is a final good for you. Or you go to a market and ask for a mobile phone. That's a final good, which has crossed the boundary line of production. No more production will happen to it. No more value addition. No more production. It won't undergo in any other production process. That is known as final good, which is ready and up for use. In particular, final goods has out of two types: consumption good and capital goods, which means that both of these types of goods are included in final goods, right? So it means this tractor, this fridge, this bowl of noodles, they're all included in final goods. Let's see another type of good. Intermediate goods. What are these? Again, in general term, intermediate goods means those goods which haven't crossed the boundary line of production. Which means a good which is used in further production of goods is known as intermediate goods. Say, for example, this butter or cheese. A local baker will use this cheese to make a cake, which means that this cheese is an intermediate good for him. Now, this is a very thin difference between intermediate goods and final goods, which we need to be very clear about. So what are final goods? Which have crossed the boundary line of production. And what are intermediate goods? Which haven't crossed this boundary line, which is still in the production process, which is still being used to produce something else. Say a wood used by a carpenter to make your bed, or this slice of butter used by a baker to make a cake. Now, a good can be either intermediate or final at the same time. Say, for example, take this butter. If you consume it in your morning breakfast, it is a final good for you. But for a baker, it is an intermediate good. He won't consume it himself. He will use it to make his cake. That cake, when you consume it, is going to be a consumption good and hence a final good for you. This difference is very, very important to understand, because what happens is in national income accounting, what we take into account is final goods, not intermediate goods. The reason will be more clear as we move forward. Okay. Next up, stocks. Now, these are not your stocks, which you see on television, right? Sensex, BSE, NSE, and all. I mean, those are also stocks, but this is something, which has a a different jargon. Any variable in economics, be it income, consumption, investment, capital, anything, are of either of two types. First up, it is measured at a point of time. Say, the most easiest example is wealth. The wealth that you have is measured today. So today, at this point of time, how much wealth you have? It is hence a stock concept. There is another concept called a flows, which are measured per unit of time. Your income, how do we tell that we have a monthly income or income per annum? So it's measured per unit of time, unlike stock, which are measured at a point of time. As the name suggests, flows means which is coming in or going out, which is flowing. Stock means set up at a particular point of time. To give you another very easy example, take up the water tank at your terrace, right? Now, the amount of water in that tank at a particular point of time, say you go right away and check now, is going to be a stock, the stock of water that you have. So what will be a flow? So when you switch on your pump and when the water comes into the tank, that fluation of water is known as flow. Got it? It's very important to understand the basic difference between stocks and flows. Any variable in economics can either be classified as stock or a flow. I've given you some very basic example, but there are many more. Right? So what do you have next? Now the question is, we have got an idea what are goods, what are stocks and flows. The question is how to measure. Now we need to have a quantitative measure of aggregate level of final goods produced in the economy. Why only final goods? We will talk on later. Why not intermediate goods, right? Why only final goods? Remember, final goods contain both of consumption goods as well as capital goods. This is very important to remember. Now, what is this quantitative measure? Now, however, in order to get a quantitative assessment, a measure of the total final goods and services produced in the economy, it is obvious that we need a common measuring rod, right? We cannot add meters of cloth produced to tons of rice or the number of automobiles. It won't add up to give you a very comprehensive unit, right? So if I add up that today in our country, say about 100 tons of rice is produced, and say about take about 1,000 meters of fabric is produced. You can't add them, right? I mean, you can't add 1,000 meter plus 1,000 tons, right? Because those are very, very different units. So you need a common measuring rod. And what is this common measuring rod? Very simple, money, right? Now, money, as simple as I've just spoken to you, it has very important role. And one of your chapters, later on in economics is related completely to money. Money has its central focus, central implication in economics. It has a whole branch of it, but more on that later. The common measuring rod that we will use to have a quantitative measure is going to be money. Hence, we can convert all these final goods from tons, meters to say a common rod of rupees for our country for that instance. So what I will do is, in very simple terms, suppose 1,000 tons of rice is worth rupees 10,000 crore, and 1,000 meters of fabric is say worth rupees 2,000 crore. Hypothetical example, I know that. So the total amount of goods or the total quantitative measure of the aggregate level is 12,000 crores. So we have a common unit, right? This is the role of what money plays in helping us to get the national income, right? It has its central role and central implication, which we'll talk later on, right? Now some more concepts, right? So here is a concept which is known as a gross investment, right? So what is this gross investment means? So in simple terms, if I again have to refer what is gross investment means, it refers to the expenditure by the producer during an accounting period on the purchase of all goods which add to their stock of capital, as well as expenditure on the replacement of existing fixed goods. Technical definition. So what is, so let me just give you in a simple terms what is gross investment. Gross investment means, so let me be clear about one more thing. When I talk about investment, for the time being, I'm not talking about investment in stock markets or in financial markets and all. For that matter, we are not delving into that topic. Right now, we are inclined towards investment in the physical protection of goods, right? In machineries, in tractors, machines, computers, and all. So what does gross investment means? It means that for a particular accounting period, what I mean is, in basic terms, a financial year. For instance, for India, the current financial year is from 1st April 2022 to 31st March 2021, right? So in a particular accounting year, how much investment a producer has made to its existing stock of capital, including the expenditure it has to make on the wear and tear of its existing capital, which means, suppose that I have 2 machines right now, and in this accounting year I add 4 more machines. So what will be my gross investment? It won't be only the monetary value of those 4 machines that I include to my stock of 2 machines. It will also include the amount of expenditure that I have to do, that I have to incur for the wear and tear of those 2 machines which I have right now, right? So I have to suppose, do some sort of mechanics on those two machines, right? So that expenditure will also be added to it. Now the first term where I add 4 machines, it terms as net investment, and that amount which I incurred on wear and tear is known as depreciation. Depreciation for account students seems pretty common, huh? Learned it earlier. The same concept is used here. This is the same depreciation, which means the wear and tear of your physical assets in a particular. Right. Now, what does this gross and net mean? Huh? We'll talk about them in detail later on. But before that, I will bother you with a few more charts, which is important. What is depreciation? So depreciation is an accounting concept. No real expenditure. This is very important. May have actually been incurred each year, yet depreciation is annually accounted for. So students of accounts will be very familiar with this technical term, but for others, so it means that it is an accounting concept. So even if no real expenditure may have been actually incurred, right? But still there is a fall in the value, right? So if you just, so for give me a very basic example, very easy example, you purchase a car today. However, when you will sell the car 1 month later, its value will be lesser than what you paid for. Why? Because there is a depreciation attached to it. This is important to know. No matter you haven't incurred any sort of expenditure on its wear and tear or anything, but you need to account it for, and this is what depreciation means. Lastly, what I have is value addition and income generation. What are these terms? Seems familiar, seems very similar to each other, value addition and income generation. So let me give you an example. Suppose Mr. X purchases wood worth rupees, say 400, right? And it converts it into a bed worth rupees 1000. So what will be the value addition? The value addition will be 1000 minus 400, which is 600. So in general terms, value addition means the amount of value that you add to the final good that you produce. Let me give you another example. Suppose I have a plant to manufacture clothes. I buy fabric worth rupees 1000, and I manufacture clothes which are now supplied for final goods worth rupees 2000. So what is my value addition? 1000. Got it? This is the meaning of value addition. Now the question is, who adds value? Like I said, Mr. X, he's adding the value. Like I said, I and the machinery are adding the value. This is a very important terminology in economics. What is known as the factors of production. So what are these factors of production? In general terms, it means those factors which actually help in production and help in producing goods and services. In general, we have 4 factors of production. What are those? Land, labor, capital, and entrepreneurship. Right? Now, what is land? Land means the actual land on which your factory or your plant is built upon. Labor, me, right? Or other laborers who are working there. Capital, as I said, those capital goods which I mentioned earlier. And entrepreneur is the owner. In very general term, is the owner. I'm not talking about various startups and all. I'm not talking about that. I'm just talking about an owner. So what are these? The implication of value addition? What is income generation? It turns out like the value that is added is actually have to be distributed among these 4 factors of production. And hence, it implies that the income generation is actually attached to value addition. So for example, for Mr. X, the value he added was worth rupees 400. 600 was the wood and 1000 was the price of bed. That amount of 400 will be distributed among his factors of production. Namely, say if he has a labor, if he has to pay rent for his land, so he pay wages for his labor, rent for his land. If he has to incur some sort of a rent for his capital as well, so if he has incurred some sort of so if he has taken on rent his capital or for physical depreciation, which I'm talking about, that will be the rental rate as well as his own profits. That's how income gets generated. Which lets me take you back to this question, or which for the food for thought which I started with you, right? Income and wealth are generated from that process. This is how income and wealth are generated in the production process. So, as I said, it doesn't matter how much bounty of natural wealth, minerals, forests, or fertile land you have. It's about how you tend to utilize them in your production process. And in that manner, you tend to generate income, which further adds to the well-being of the people living in a nation. So, lastly, what does national income means? Again, I reiterate, it is another accounting concept, right? Which has a technical definition as given here. But in simple terms, it just means the monetary value of the goods and services produced in a nation. There are many components to it. There are various methods of doing it. There are many additions, subtraction. There are further bifurcations in national account. But we'll talk about them later on. Hence, what generates income then? Production. The value you are getting. That is what is actual income, the factors of production. Okay. Thank you and stay safe.